Hey everybody, I just wanted to explain a little bit about debits and credits to you. This can be confusing when you first learn about it, but the more you get used to it, the more it's not too bad. So debits and credits are the process we use for recording accounting information. And the first thing I want you to know is that the terms mean they only mean directional things. So a debit just means left, or the left side, and credit means the right or right side of a T account. So what we have on the screen here is a T account, and a T account represents the balance of any account in accounting. And so as we work with these more, you'll see more examples of it. Just remember, debit means left and credit means right. Somewhere along the way, many people learn to think that debit is bad because in their bank account, a debit means money's going out of their account, and they don't like that. And credit means good because it means money's coming into their account, and they do like that. But try to just get rid of that whole idea of debits and credits from a banking standpoint. We can talk later about why they use the terms they do and the way they use them. But what's important to remember right now is that debit just means left and credit means right. So when we're tracking accounting transactions, that we're going to use debits and credits to record them in our T accounts. And so some types of accounts are increased with debits and decreased with credits. Other accounts are the opposite, where they are increased with a credit or decreased with a debit. So that can be confusing. Take a look. This is the accounting equation that we've looked at in the past. Assets equal liabilities plus equity. And we'll see that assets, they increase with a debit and decrease with a credit. Liabilities and equity are the opposite. And it would make sense that they're the opposite because they're on the opposite side of the equal sign. So they're gonna behave sort of in a reverse way to how assets behave. Also, you'll see it says normal on there, and you'll notice a pattern, and that is that normal is always on the side with the plus, or always on the side that increases the account. So the normal balance of an account is simply the balance of the account that we would expect to see. And since we would expect to see positive balances in accounts, not negative balances, then the normal balance is always the side that increases the account. So that's a pattern you'll see over and over, and just recognize that normal balance is always the side that increases the account. Now I'm going to do the expanded accounting equation here, because we know that that for equity, we have four types of accounts that we're dealing with. The owner's capital, or money put in by the owners, and the owner withdrawals, and that's money pulled out by the owners. Revenues, that's money earned by the business, and expenses, money paid by the business. And we know that owner capital and revenues both increase equity. And so we're going to recognize that those will have that normal relationship where for equities, where the debit is decreases the account and the credit increases the account. But owner withdrawals and expenses, they'll be the opposite. A debit will increase an owner withdrawal account and decrease an owner with credit will decrease the owner withdrawal account, and expenses will behave the same way, increase with a debit, decrease with a credit. You might be saying, why, right? Why is this the way it is, and what the heck? And we learned about a friend, the Italian monk, who came up with this whole system. And the short answer is just that this is the way it has to be in order for it to all work together. For example, if I were to buy an asset, let's say I buy a piece of equipment for cash. In that case, I would have an increase to an asset called equipment, so that we would debit the equipment, and a decrease to an asset called cash. And so we would credit the assets, the asset cash. And the way this works is there's always an equal amount of debits and credits for any transaction, and it always balances. Take another example. Our business earns money. Well, what happens there? Our cash increases and our revenue increases. And so To increase the asset cash, we'll debit. And because revenue follows a different sort of rule, to increase the revenue account, we'll have to do a credit. So we'll have both a debit and a credit, and they'll balance. One third example is if we were to pay our expenses. Okay, well, we would pay that with cash. So we would say, as we pay an expense, we would say that's an increase to the expense. So we would do a debit entry for our expense. And then our asset cash would be going down. So we would credit cash. So just recognize that each time we do a transaction, we'll always have a debit and a credit, and the debits and credits will always equal each other. And the way these are set up, which seem a little scary and confusing at first, where asset accounts increase with a debit and decrease with a credit, and liabilities do the opposite. And the increasing equity accounts, owner's capital and revenues, they also behave the opposite of assets. That has to all work together that way so we can make these dual entries. And in the future, we'll do some examples and you'll start to just get a feel for it. And after a while, you'll wonder why it seems so hard in the beginning.